Hey everyone, Michael here. After the Smart Money Concepts video took off, I thought we should go over another extremely useful indicator that only 5% of investors truly understand how to use. That's right, the RSI or Relative Strength Index. We're going to cover what the RSI is, how to set it up on TradingView, and how to use it in your day-to-day trading strategy to create a passive income. And then also go over a few settings that go beyond the default configurations. That way you guys have a premium setup that nobody else has. This is going to be a step-by-step tutorial so you guys can become better at trading stocks, crypto, and Forex. So don't be afraid to pause or rewind the video to make sure you guys don't miss a thing. To start everything off, you guys are going to want to log into a TradingView account and open the chart of an asset you want to analyze. This can be a cryptocurrency, a stock, or a Forex pair. Today I'm just going to be using Apple. Next, you're going to click on the indicators button at the top of the screen, and in the search bar, you're going to type in Relative Strength Index or RSI and select the indicator from the list. Next, the RSI indicator will now appear in a separate window below the price chart. Before we dive into using the RSI, let's first understand exactly what it is. The Relative Strength Index is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100 and is typically used to identify overbought and oversold conditions in any market. The standard settings for the RSI are a look-back period of 14 and levels of 30 being oversold and levels over 70 being overbought. The standard RSI only has the RSI line, but TradingView has an additional line right here called the RSI-based moving average, which I will talk to you guys more about in the next few minutes. Here are a few of my favorite ways to trade using the RSI. The first one is crossovers. One of the primary ways to use the RSI with the RSI-based MA line is to look for crossovers between the two lines, like golden crosses and death crosses. When the RSI line crosses above the RSI-based MA line, it can be considered a bullish signal, indicating a potential uptrend or reversal. Conversely, when the RSI line crosses below the RSI-based MA line, it can be interpreted as a bearish signal, suggesting a potential downward trend or reversal. The next is a classic, using it to look for overbought and oversold levels. When the RSI crosses above the 70 mark, that asset is considered to be overbought and may indicate a potential reversal to the downward side. Conversely, when the RSI crosses below 30, the asset is considered oversold and may signal a potential reversal to the upside. If both the RSI line and the RSI-based MA line are in the overbought or oversold area, it may strengthen the reversal signal, and for me, it does. Divergence occurs when the price and RSI values move in opposite directions, potentially signaling a massive reversal. With the RSI-based MA line, you can look for divergences between the price and both the RSI line and the RSI-based MA line. For example, if the price makes a higher high, but both the RSI line and the RSI-based MA line make lower highs, this could be a bearish divergence, indicating a potential downtrend. Conversely, if the price makes a lower low, but both the RSI line and the RSI-based MA line are making higher lows, this could signal a bullish divergence, suggesting a potential uptrend. For those of you guys who like to day trade during strong momentum, this is going to be one of your favorites, the trend confirmation. The RSI-based MA line can be used to confirm the overall trend direction. If the RSI line is consistently above the RSI-based MA line, it may indicate a strong bullish trend, while the RSI line consistently below the RSI-based MA line may signal a strong bearish trend. Now that we have gone over the basic strategies, it's now time to look at some more advanced ones that are often ignored by other investors on YouTube. That means changing up the moving averages within the indicator itself. Using different types of moving averages with the RSI can provide various insights into the market momentum and potential trade signals. Here's how each moving average type can be used with the RSI for bullish and bearish signals that are designed to make you more profit. Now, if you want to change any of these settings for yourself, simply go over to the RSI settings and go to the bottom where it says moving average settings. Next to the MA type, you're simply going to click on the SMA and a drop-down menu will occur and you guys can choose any type of moving average that you guys would like. The default setting, of course, is the simple moving average. The simple moving average calculates the average of the RSI values over a specific period. It is straightforward and gives equal weight to each data point. A bullish signal occurs when the RSI line crosses above the SMA, while a bearish signal occurs when the RSI line crosses below the SMA. Next, we have Bollinger Bands. Bollinger Bands are a set of lines plotted above and below an SMA at the specified standard deviation from the average. Although using Bollinger Bands with the RSI is less common, you can apply the concept by observing the RSI line's position relative to the Bollinger Bands. A bullish signal may occur when the RSI line crosses above the lower Bollinger Band, while a bearish signal may occur when the RSI line crosses below the upper Bollinger Band. Then we have the exponential moving average. The EMA gives more weight to recent RSI values, making it more responsive to price changes. A bullish signal occurs when the RSI line crosses above the EMA, and a bearish signal occurs when the RSI line crosses below the EMA. You swing traders are going to love this one, the smoothed moving average or modified moving average. The SMMA is a variation of the SMA that gives equal weight to all RSI values. However, it smooths the data a little bit more efficiently. A bullish signal occurs when the RSI line crosses above the SMMA. Again, while a bearish signal occurs when the RSI line crosses below the SMMA. After that, we have the weighted moving average. This one is very, very good for those of you guys like to day trade and scalp. The WMA assigns more weight to the recent RSI values, similar to the EMA, but with a different formula. A bullish signal occurs when the RSI line crosses above the WMA, and a bearish signal occurs when the RSI line crosses below the WMA. And finally here we have the volume weighted moving average, the VWMA. The VWMA takes into account both the RSI values and their corresponding trading volume. Although using the VWMA with an RSI is unconventional, you can interpret bullish and bearish signals similarly to other moving averages. A bullish signal occurs when the RSI line crosses above the VWMA, while a bearish signal occurs when the RSI line crosses below the VWMA. Now, below those settings, you guys are also going to have the opportunity to change the MA length and the BB STDEV parameters, okay? Now, here's an explanation of each parameter and how you might change them to make more profits. The first one you can change is the moving average length. The moving average length is the number of periods used to calculate the moving average applied to the RSI values. By default, the moving average length is set to 14 periods, which is the same as the standard RSI lookback period. Changing the moving average length can affect the sensitivity and responsiveness of the RSI-based MA line. This is only changing the RSI-based MA line, okay? However, with a shorter moving average length, using a shorter moving average length, for example 7 or 9, will make the RSI more responsive to recent price changes, resulting in faster moving averages that can generate more frequent crossover signals. This may, however, be better for short-term traders, but you guys have to understand more signals leads to more false signals, okay? Next, we have the longer moving average length. If you guys want to change it to something more of the realms of 21 or 28 from 14, this will make it less sensitive to short-term price fluctuations, resulting in smoother moving averages that can provide a clearer indication of the underlying momentum trend. This is most likely going to be suitable for all of you guys that prefer to do long-term investing or swing trading, because it takes away a lot of the extra noise that happens in a very volatile moment. Next, we have the BB-STDEV, or the Bollinger Band Standard Deviation. This is only for the Bollinger Band setting in the MA, okay? Now, this parameter is only relevant if you guys have selected the Bollinger Bands as the MA type for your RSI-based moving average line. This parameter represents the standard deviation multiplier used to calculate the upper and lower Bollinger Bands. By default, it's set to 2. Which means that the upper bands and the lower bands are plotted at a distance of 2 standard deviations from the RSI-based MA line. Now, there are 2 ways to do this. You can lower the number or you can increase the number. If you guys want to lower the number, I'd recommend moving it to a 1.5. Decreasing the Bollinger Band standard deviation will narrow the Bollinger Bands, making them closer to the RSI-based MA line. This may result in more frequent interactions between the RSI lines and the bands, potentially generating more trading signals. Just like before though, it could also lead to an increased number of false signals, but the majority of the time you guys are going to enjoy those signals. Afterwards, we have the higher deviations. So if you guys want to move it higher, I would move it up to 2.5. This will widen the Bollinger Bands, making them further apart from the RSI-based moving average lines, and this can also make signals generated by interactions between the RSI line and the bands less frequent, but potentially more reliable, as the bands encompass a larger range of RSI values. Now, some of you guys may be asking, Michael, you haven't talked about the look-back period yet, and that's what I'm going to do right now. You guys can absolutely change that 14 number to anything you guys so desire. So you guys are going to have to experiment with it, but here are some numbers that I would put in there instead of 14, especially if you guys are looking to do more specified swing trading versus more specified day trading, okay? The first number that you guys can put in there is the 7 period, okay? It's a shorter look back period like 7 will make the RSI more sensitive to recent price changes, generating more frequent overbought and oversold signals. This setting can be useful for short-term traders or in markets of higher volatility. After 7 comes 9. Another popular alternative to the default 14 period is the 9 period RSI. This setting is still sensitive to recent price changes, but offers a slightly smoother representation of momentum compared to the 7 period RSI. Now, for you swing traders, you guys are going to probably like these ones. The next one is going to be the 21 period. Using a longer look-back period as 21 will make the RSI less sensitive to short-term price fluctuations, providing a more stable representation of momentum. This setting might be suitable for longer-term traders who are looking to filter out market noise in a lower volatility environment. Think of more of the stock market. The 28 period RSI is also something I would highly recommend. It offers an even longer perspective on the market's momentum, further reducing the sensitivity to short-term price changes. This setting can be beneficial for traders who want to focus on long-term trends and avoid frequent overbought and oversold signals like we have a lot of in this market. Now, there is one more thing I think you guys would love to change here, and this is the default levels to determine overbought and oversold settings. The default method is 30 to 70. So if you're below 30, you are oversold. And if you guys are above 70, you guys are overbought. You guys can change these levels, so it's something more of 25-75, or you guys can make it more of 30-70, which is the default, or something more like 65-35 to adjust the way you guys see the different oversold and overbought ranges. This can be very useful if you guys are trading in a sideways market where a lot of stuff is boring. A lot of times in those sideways markets, we really don't get into those overbought and oversold territories, which can be very annoying if you guys are looking for smaller swing trades in between the 15-minute and the hourly charts. Now, it's your job to backtest all of these to make sure they fit your personal strategy before you start investing with real capital. If you guys enjoyed this video, please make sure to smash that subscribe button, and I will see you guys in our next tutorial. Thank you so much.